Hello friends, this is your host Rakesh Kumar. In the previous video regarding head and shoulder pattern, we have already discussed how to identify this pattern and what are the do's and don'ts while trading this pattern. In this present video, we shall be seeing a few examples from the live market so that you can identify and trade this pattern comfortably as and when it emerges on the instrument that you have opened in your trading platform. If you have not subscribed to our channel yet, then you can do it now to get notification of the latest video uploads. And if you find this video useful for you, then please consider pressing the like button below the video. But before we begin, let us have a look at the risk disclaimer. It states that the futures, stocks and the options trading involve substantial amount of risk. Your capital is at risk, the losses can exceed the investment. The information is provided as is, and the user of the information assumes the entire risk of any use it may make or permit to be made. So let's get started. Before proceeding further, I would like to have a small recap of what we have learned about this pattern until now, so that you can understand everything what I say. As till now we have seen that head and shoulder pattern forms when there is a prior trend. We need a prior trend in the market. I'll show you now. This is a head and shoulder pattern, but how it is formed, we need a prior established trend. Okay, there should be a trend. After that we need a left shoulder. You see there was a peak and then there was a decline. So this peak is termed as a shoulder. We have named it as a left shoulder already. And then there is a need of a head. Head is formed after there is a rise from the decline from the left shoulder. So this is the head. Of course, this head is higher than the left shoulder as is seen in the human body. Then we need a right shoulder. Now you can see clearly that a decline from the head came to this level, and then again it had rise, and this peak formed is called the right shoulder. Then we need a neckline. Now how this neckline is formed is very important. The neckline is formed by joining the decline, the low of the decline from the left shoulder to the low from the decline of the head. I'll make you understand. Now there was a decline from the left shoulder and it ended up here. Then again there was a rise and there was a decline from the head and it ended up here. So if we join these 2 points and extend them to the right, then it is called a neckline. Okay. Then we need a break of the neckline. Now this neckline should break when there is a decline from the right shoulder. When there is a decline from the right shoulder, this neckline should break in the process. Okay, this neckline should break in the process, and the retest of support there. Now this neckline is also termed as a support. Now this is a support. This retest of support turned resistance is important for us to enter the market. We are not going to be aggressive traders. We will wait for the retest of the support and check that whether it acts as a resistance or not, and then we will project the target. Now how the target is projected, the target is equal to the height of the pattern from the point of break. Now if the pattern has broken here, then we will measure from here till the head, top of the head. Now here it counts to be amount almost 356.5 points. So we will project it 356.5 points to the downside. Here 356 points, almost the same. Okay, so we have already mentioned this price 1.59272. This is the approximate target from this pattern, and our entry will be here. The stop loss will be slightly higher than the neckline, and take profit target will be this. In most of the cases you get more than 1:3 risk to reward ratio, which is a very good risk to reward ratio in order to do a consistently profitable trading. Now I was committed in this video to show you some examples from the live market, so let's go ahead. The first example is coming from the chart of gold. I have already marked the position that I wanted to tell you. Now first, as we have already discussed what all we need for a head and shoulder, we will compare it with the live chart. Okay, first we need okay, I will show you like this. First we need a prior trend. We will see that whether there was a prior trend or not. Okay, you can see there was a prior trend. The price was making higher highs and higher lows, so there is a presence of trend. Then we need a left shoulder. Okay, so this is a peak. Why the left shoulder can only be counted when there is a head, and after that there was no higher high than that. So this is your left shoulder. So this comes out to be left shoulder. Now after that we need is a head. Of course, this is the most prominent part. I will delete this one. This is the most prominent part, so this is the head. So we will mark this point as a head, and after that what we need is a right shoulder. Of course, we need a right shoulder, so the decline from head is till this point. In fact, till this point. Then we had a rise, and this is the high, so this will be our right shoulder. So we will name it right shoulder. Now we need a neckline. How will we make a neckline? I have told you that the neckline is formed by joining the declines from the shoulder and the head. Okay, so we have joined these already and extended it to the right side. So this is our neckline exactly. And I must tell you that the lines are not the exact lines, actually they are the zones. Okay, they are the zones. So if you clone it like this, I will tell you that the zones are formed like this. The zones are formed like this. So this is essentially a zone, but for the ease of understanding, we'll keep it a line. And then after we need a break of neckline. In this example, can you see this particular candle breaking through this line and closing much lower than the line? Of course I can see, then you can also see. So this is the break of the neckline, and we have got all these confirmation till now. And then we need a retest of support turned into resistance. So earlier this line was acting as a support. You see here how many times this has supported the price, even here. Now this has broken, and now it is acting as a resistance for the price here. So this is the place where we have to enter the market with a small stop loss higher than this place, and take profit will be equal to the height of the pattern from this break. So it is 2653 points. 2653 points. 2653 points are approximately equal to 1312.95 or 1311 points. Now the price has taken this target very easily. What was the height? It was 2653. 2653, approximately 1312. Okay, you see the price target was taken very comfortably by the chart. So this is how you have to trade. I hope this example is clear. I will give you another example. Now this is an example of the euro against the Polish krone. Euro PLN. Okay, so in this, if you now you should remember, well, there was a trend, higher highs, higher lows. Now this high is higher than this one, but this high here, these highs or this particular high is lower than this one, so this is already ahead. So do we need to say anything? No. So this is the left shoulder, this is the high, now this is the right shoulder. How we form the neckline? A decline from the left shoulder and a decline from the head. If we join them, then this becomes a neckline, and the decline from the right shoulder should be able to break the neckline. So it has broken here. Then we enter the market at the retest of this neckline. If it is rejected, like here this candle, if you see this particular candle was a bearish engulfing, and also it has made a pin bar at the resistance, so it is an indication that the market is going to go down. So we enter here with a small stop loss higher than this, and we take profit which is equal to this height, which is 744 points. So 744 points are coming to approximately 4.358. 4.358. So we have reached the targets, and from there the market took some support. Okay, so now this is another easy example. I will go to a weekly example, weekly chart. Now this is a weekly chart of the US dollar against the Canadian dollar. If you can see that the market was in an uptrend here, it was making higher highs, higher lows all the time. And here at the time of reversal, what it did was, initially it was making higher highs, but eventually it made a lower high. Now whenever market makes a lower high, the rising trend lines are in jeopardy. Okay, if we make a rising trend line, now this trend line is in a jeopardy because it has been broken. So next time, if the high made is lower than the previous high, there is a possibility of head and shoulder pattern forming, and which actually was made here. You see, this is the left shoulder, this is the head, this is the right shoulder, and if we join the lows from the left shoulder to the low of decline from the head and extend them to the right, then it becomes a neckline. And if the decline from the right shoulder breaks this neckline, then it is a confirmed pattern, and we enter at the retest of this line. You see that when the market tried to test this line, it made a bearish engulfing candle. Now bearish engulfing candle is itself a signal of sell at the resistance. So we could sell this market here with the target. How much should be the target? We know the stop loss, of course, it should be higher than whatever the candle pierced or tested the neckline. In this case it was the bearish engulfing candle, but at the break and the high, the point is 1188. So we go down to 1188 and we book profits near 1.3785 level. Okay, 1.3775 or 1.3785 level. This is the approximate target, and the market actually could do it very comfortably. You see, most of the time your head and shoulder pattern takes profit very easily. There is one more example in the US dollar against the Japanese yen. I hope by now you can easily see where is the head, where is the shoulder, where is the left shoulder. Okay, in case the market was going in an uptrend and it made a left shoulder here, it made a right, it made a head here, then there was a decline, and then there was a right shoulder. We joined the decline from the left shoulder to the decline of the head, and then we extended it to the right. The decline from the right shoulder was here, and it broke and closed the candle below this. Then there was a retest after some time, after almost six candles there was a test, and then we eventually saw that the candle went higher and eventually closed lower than this neckline. So it was a sell signal for us. What is the stop loss? Stop loss is higher than the candle high, and take profit is equal to the 158 points when we extended it down from the break. Okay, it was 160, it was 111.50 almost. Okay, 111.50 was the target, which was taken very easily by the market. So you see, trading head and shoulder pattern is very profitable if you just identify the pattern. So do it and practice more and more in demo or in real if you want to, but be sure to identify the trade and don't forget the do's and don'ts that I have shared. I have also told you that the price may keep going in your direction, but you have to limit your greed and you have to book profits whenever it hits the initial target of the pattern height or it hits any good support on the way. If you have identified good support on the way, for example here this was the previous support. If the price has in this case, see, the price had a target, for me it was 160 points, but 160 points is below the previous support. So in my case I will definitely book profits near 111.66 or 111.70 level. So I will not wait for the target of the pattern to be achieved. I'll book profit here because there is a very high probability that this support will push the prices higher again. In this case it did not happen, but there is a chance that this support will push the price higher and I will not be able to fetch equal results if I ignore this support. Well, that's all for this video. Thank you very much for watching this video.